Well, so how about it? How big a mess is the housing crisis, and is the bailout worked out by some of the nation's biggest banks going to be enough?
We're joined again by our panel, Peter Schiff, president of Euro Pacific Capital, Pat Powell of Powell Financial Group, and of course David Tice, portfolio manager at Prudent Bear Funds. So David, I'm sure you heard the Secretary's comments today. It was a very alarmist speech he gave this morning.
Well, Paulson has got to be careful not to be too Pollyannish here, and he can't, because we think things are going to get worse, and he has to maintain some credibility down the road when things do get worse, and he can't come out and say everything's fine when it's not going to be fine.
Has he been doing that?
Well, I think he's been a little bit too Pollyannish before, and now he's getting a little bit more austere, and I think that's probably appropriate.
Is there a danger of swinging too much the other way?
Potentially, but it depends on how bad it gets, and he's certainly looking at things, and it's not pretty out there. The credit markets are still in disarray. There's still a big problem in structured finance, and housing is still in steep decline. It's still tough to get a jumbo mortgage. It's going to be tough.
Well, then, Pat, why did these banks come out yesterday and decide to take a gamble on mortgage-backed securities?
I don't think they have a choice. I really don't. I think they're stuck with. A lot of them have the portfolio. They've had their fingers in these pies for a very long time. They were on automatic pilot. They weren't doing what bankers usually do, and that is looking at loans. The securities industry securitized everything, so the original bank maybe who gave the loan, it ended up eventually into the open market, and there's all kinds of people that are owning these have no idea what they've actually purchased.
Were they in danger of going broke? Some people have suggested that they had become decapitalized, and if there had been a run on a bank, they wouldn't have had the cash.
Well, earnings are down, but they're not negative, and these are pretty well diversified banks. I think you're probably referring to the Citigroup,
which you own some.
I own some Citigroup, and real unhappy with the situation. But they have not been doing what bankers normally do, and there's going to be a price to pay, and the price is going to be they're going to have to work this through. It's not in their best interest to foreclose on loans. It is not in their best interest to throw people out on the streets. Every bank has a loan workout group, and what you do is they work with businesses, they work with consumers who have trouble trying to find ways to make something work. And I think anyone out there who's in trouble, this is where you go to start.
All right, so Peter, over to you. The word bailout keeps getting tossed back and forth. Is the government bailing people out, or is this just letting the free markets work? These people signed these documents. They signed them.
Yeah, you know, first of all, no one's going to get thrown out in the streets. There are plenty of houses to rent. I know. I'm renting one myself. All that's going to happen to people who can't make their mortgage payments, if they can't renegotiate with a bank, they'll go rent something they can afford. You know, most of these people bought with nothing down, so what do they got to lose? Or if they put something down, they extracted it in a home equity refinance. It's the creditors who are going to lose, and the government needs to stay out of it. But the bigger thing is people are underestimating the impact on the economy from the bursting of the housing bubble. You know, when these mortgages reset, it's not that people have a lot of a slush fund out there to pay these higher mortgage payments. Even if they can afford it, it's going to come at a complete collapse of discretionary consumer spending.
Well, Peter, let's talk about the long-term picture, though, because, look, the subprime business is dead. Gone.
Of course.
There's no more of these borrowers out there.
It never should have existed in the first place, and it wouldn't have existed if Alan Greenspan didn't keep interest rates so low, and if foreign central banks and other foreigners didn't have so many dollars that they earned by selling us products that we couldn't afford. They're the ones that bought all this securitized crap in the first place.
You know, there's a place for subprime lending, and I would differ vehemently on this issue. There are a lot of people that are in a house today because of subprime lending.
And
now, not everybody.
Hold on a second, Peter.
Not everybody's going to make it, but the vast majority of these people are making timely payments on their mortgages, and that's the only way that they got into a house. Home ownership.
By the way, you say vast majority. Hold on, Peter. You say vast majority. What percent are in the foreclosure stage?
Foreclosure, I don't have the exact figure, but some form of default or behind is about 14, 15%.
Peter, go ahead.
If you can't save up 20%, if you can't afford a fully amortized mortgage, you've got no business buying a house. You should rent. There's nothing wrong with renting.
That's one theory of lending. There's another theory. That's a theory of lending. There are asset-based lenders, and then there are lenders that will lend on income. Well, and some of them got carried away. I agree that there's a problem in subprime lending, but I don't want to throw the baby out with the bathwater. There are many people who are in their homes because this market actually existed, and creditors took a risk, and they should pay for the risk if they misgauged it.
Peter?
Well, I agree. Creditors are going to pay. But, homeowners, what's going to change is these fantasies of instant wealth by owning homes. We created a whole nation of speculators. People thought real estate prices were going to go up forever. So they committed to mortgages they knew they couldn't afford because they thought they were going to get rich. And now that, they realize that they bought into a bill of goods, just like they did with the dot-coms, we're going to pay the consequences.
Want to get in the middle of this?
Yeah, I agree with what Peter said, and agree that the financiers got too aggressive. They lent too much money to people just because they were trying to get a fee. And the problem was structured finance, where you didn't have a banker that sat across the table from someone that held that loan. Instead, somebody was making a loan. It was securitized. They didn't really care. Therefore, they fudged the numbers, the income numbers, the collateral numbers, etc. That's the big problem.
But what all this means is we're going to get more regulation, right?
I hope not. I hope you let the free markets work it out. The free markets will do it in the most efficient and
Already
cheapest way.
Senator Schumer and others have come in with suggestions. Go ahead,
but
Peter.
It also means we're going to get much, much lower home prices, because the only reason real estate prices got to these ridiculous levels was because of these crazy lending standards. Once they go away, the artificial home prices that they supported are going to go away, and people are going to have to get used to seeing their houses 30 or 40 or 50% less than what they think they're worth.
All right, we're going to leave it there. David, Peter, Pat, thanks to all of you.